next, we've got a fantastic presentation from Tickmill. We've got Joseph Dahrieh. He is going to talk to you about current inflation and gold forecast.
Hello everyone, this is Joseph Dahrieh, market strategist at Tickmill. I'm a certified financial technician and specialized in Elliott waves. So basically, this will be an interesting session to talk about gold and current inflation prices. Many traders at the moment are hearing about the inflation prices, or the inflation percentage is going up. So basically what's top on mind of the investors right now is to buy gold, because gold prices should go up in correlation or in positive correlation with higher inflation prices, as we all know. So in today's presentation, I will talk about the historical inflation prices, when we used to have like high inflation prices in certain brackets of years, and then we will turn into the chart or the MT4 charting to analyze the gold prices and predict what's going to be next, or what's the next projection for the gold price. So if we go back in history and we talk about inflation, we can see that in year 1970 till 1979, we used to have the highest inflation prices, which is near 7.5, 7.6%. 1980, 1989 as well, we have very high percentage of inflation. We're talking about 4 to 5%. We all know that the benchmark for the inflation for the Federal Reserve in the USA is near 2%. So basically, when we talk about inflation 5 to 7%, it's huge. That as well mean that the consumer price index is going up as well, and all the products in real life are getting expensive. So we directly expect that the gold prices will as well go higher in the future. So I took a bracket, or at least I took 3 brackets in which we have the highest inflation prices between 1970 till 1979, the second bar and the third bar. I took the 3 bars over here just to focus on the inflation rates and the high inflation rates, and to check the gold return or the gold yield in these brackets or in these bar charts, to check if gold prices used to have a positive correlation with inflation or with higher inflation. So I took these 3 brackets, all right, and the source is from the CNBC. I took these 3 brackets, 1973, 1975, 1980, 1984, 1988, 1981, in which we have the highest inflation prices. And we can see the gold price is the yellow bar chart, is the yellow chart. We can see that in 2 brackets, 1980, 1984, we had a negative yield or a negative return in gold, as well as in the bracket of 1988, 1991, we have a negative yield or a negative return in gold as well. Only in 1973, 1979, we had the positive yield return. That means 2 out of 3, the gold return was dropping, or gold prices at the end of the day was dropping, while the inflation was going higher. So between gold and inflation, we definitely not have direct or at least short-term positive correlation. So these are the numbers right here. We can see that the first bracket, gold investors lost 10% in their investments in gold, while the inflation was at 6.5%. And in the second bracket, the gold yield negative 7.6%, while the inflation was about 4.6%. However, the gold returns in 1970 till 1979 was positive, in return with the inflation rate was almost high. So 2 out of 3, the gold inflation ratio was not at its best, and the gold was not the best anti-inflationary hedge, if we call it to be true. Here we can see, like, I'm not going into details, I do not have much time, I'm sorry. However, if we can dig into this chart, we can see that the gold return, which is in green, the green dots, yielded positive when we had higher inflation, specifically when we used to have a global financial crisis. So if we go back to the Q4 of 2007 till Q2 of 2008, in which we have the supply mortgage crash in the USA, gold yielded positive returns while inflation was high. So actually, if we look into gold investments on the long term, 5 to 10 years, and we look into gold returns and investments during financial crisis, this is where gold surge or gold price go higher. So at the moment when we hear about the Federal Reserve, about the tapering, about everything, the current inflation prices are going up, inflation is out of the box right now in the numbers. We do not directly run into gold investments. As you can see right now, gold prices, by the way, is going down. So inflation is going up and the gold prices are going down at the moment. We saw a dip at first to 1680 and then we saw a flash crash to 1680 again, so it's a double bottom at the moment. I will show you some technicals, by the way. Can we please put the chart? So we will look into more technicals, let's say. I think the green pointer is better. Okay, so this is gold prices. We can see here that gold topped near $2,073 per ounce, right? Because I'm specialized in Elliott waves, we consider that the rise from 1200s till 2073 was an impulsive wave. When we talk about impulsive waves or emotive wave in Elliott waves, we talk about 5 waves up. Our count was that the top of 2073 was the wave 3. And the current corrective phase in gold was wave 4. I will talk about some predictions and some scenarios about gold. When we talk about corrective cycles and corrective waves, we talk about a simple corrective wave or a complex corrective wave, a zigzag, a double zigzag. So we might have a very complex corrective wave in wave 4, however, the trend is still up. We might see another surge, another upside momentum in gold. However, we do not know exactly the timing when will it go up. So if you're not a risk taker, you're a risk averse, for example, we need to wait for a confirmation, for an activation above the trend line, which is at 1835. 1835 is the activation point. However, the first scenario for gold, if you're a bullish, if you have the sentiment of a bullish trader on gold, I can tell you that gold might and can technically go up from the current levels, because the complex corrective wave can be finished at WXY near the 1680, and we have done like several bottoms on this area. The impulsive wave, we can label it as a wave 1. The corrective pullback and the flash crash that happened, we can label it as a wave 2. And now we are looking into another surge in gold. So technically speaking, we can have a surge in gold, but I do not prefer this scenario. The preferable scenario is that instead of wave 1, we can put another connector for a more complex wave. That means we can have here, instead of one XX, double X, and we can have another corrective cycle, which is an ABC. We can retest 1630, 1640 level before going up. So if you're looking into gold investments, do not hear about inflation. Do not focus on inflation, because as I told you and as I showed you in the charts before, if you look into inflations and gold prices and the correlation, you need to look 5 to 10 years investment, not a short-term investment. So if you're looking about investing in gold, you need to buy gold from here. If it goes down to 1630, 1634, you can buy a lot more. So basically, I still see that this fall in gold is corrective. We might see another surge to the missing leg wave 5 in Elliott waves that might target 2,300 and 2,400. However, we do not know the time frame, actually, when will it happen, or our targets in terms of time frames. So basically, we need to finish this corrective pullback, all right, in order to get the activation again at breaking 1835 level. So if you have any questions, I will be at booth number 18 at Tickmill. I will be ready to answer all your questions. Thank you.